We reported our half-year results at the 30th of June, so we are a little counter-cyclical to everyone else. I think key to that was we successfully completed a capital raising just before the end of the period on the 28th of June, and at that time upgraded our guidance from 13.07 to 13.2 cents per security, and that guidance remains unchanged. We've continued to grow our business through a number of acquisitions that we have completed. That's 12 to date since we IPO'd this time last year, and are continuing to do work on our capital management structure, I think evidenced through both the capital raising that we did on the equity markets as well as a new bilateral facility that was completed at the same time. In terms of our financial highlights, as I mentioned, it was half year. And we paid 6.6 cents per security out to our security holders on the 11th of August with a statutory net profit of $43 million. Our net tangible assets were $2.07 per security, but after paying that distribution, they are at $2.01. I just briefly wanted to touch on, the portfolio and what we're seeing in the market. So our portfolio is now over $2.2 billion worth of property. That's 437 assets spread right across the country. We have 77% of our sites in metropolitan areas, and obviously the balance are then in regional areas, and we certainly believe that's reflective of the quality of our assets. Our yield currently is sitting at 6.2%, so seemingly very attractive, and our gearing is sitting below our target range. Our target range is 35 to 45%. We're sitting at 33.8%, so we do have some additional debt and balance sheet capacity to be able to fund additional acquisitions should they come along. I might get my colleague Guy just to touch very briefly on the high-level financials, and if there's any queries, we'll take them quickly.
So rather than pull apart the financials for you, you'll be relieved to know that I'll just touch on some key metrics that might be of interest to investors. The background here is that we have a weighted average lease expiry of 14.2 years and 3% set rental increases that occur every year, that when you take into account the leverage will drive 4% distribution growth before any other changes. So some of the key numbers out of the result were, in terms of distributable income, that was 6% above the prospectus forecast that we issued in August of last year. That was due primarily because we successfully purchased some additional assets, and secondly, we're running the business for less, both in terms of the operating costs and secondly, the interest costs. NTA at $2.01, and the key event that will occur around NTA is that 1/3 of the portfolio will be valued as at the 31st of December 2017. So that process will start soon. Balance sheet, 34% levered, with a weighted average debt expiry of 4 years. Now we're going to look at that debt expiry profile in the coming months with a view to trying to better match it to the very long-term leases that we have here. Acquisition capacity. There's $150 million worth of acquisition capacity available. I'll leave you to draw your own conclusions on how debt pricing might look and how we might put together a debt book, but the last set of acquisitions we made, when aggregated, had a weighted average capitalisation rate of 5.9%. That's consistent with the IPO portfolio. In fact, exactly the same number. And going forward, our forecast has been upgraded to 13.2 cents per security for 2017, and that excludes the impact of any acquisitions we might do with that $150 million worth of capacity. Now, just by the way the timing runs, that's much more likely to have an impact in 2018 than 2017, but it's worth bearing in mind in what you think the business might be able to do next year.